Chalo. Let's understand what is the idea behind a new technique of costing called life cycle costing. And in a lot of ways, it is a very stupid technique. Why? Or rather, stupid se zyada, I could call it an easy technique because there is nothing sophisticated here. You take the In the numerator, you take the total costs that are expected to be incurred over the entire lifetime of the product. In the denominator, take the total number of units that you expect to produce over the lifetime of the product. Numerator upon denominator gives you the total life cycle cost per unit. It is that simple. Now, I'm not saying that this approach doesn't make sense. This approach is also, it has been made with a certain scientific perspective. What is that perspective? Say, for example, someone wants to set the selling price per unit. Now, when the product is just launched, it is in its nascent newborn phase. Naturally, there are certain costs that are incurred, like there are heavy marketing costs, there are heavy promotion costs that are connected with the product. And you don't really have a choice. You have to incur these costs because unless you spend on marketing, unless you spend on promotion, people will never become aware of the product and they will not buy it. So initially, the marketing cost and the promotion cost and all of these are high and they later on reduce over time. Say, for example, in the initial couple of years, after considering the marketing cost and the promotion cost and all of these costs, you realize that the cost per unit is coming to 25 rupees and you have set the selling price at 18 rupees. You would want to discard the idea of this product because you feel that the product is not making enough money. But if you have a proper analysis of data over the entire life cycle of the product, you will end up realizing that as time passes by, after 6 months, after 9 months, after 2 years, the cost per unit goes down because now you also have achieved economies of scale. And as time has passed, the promotion costs have gone down, because people are now aware of the product. So in the long run, the product is going to make decent, good profits. So discarding a product right now, because at the moment it is not expected to generate profit and that it will generate profit later, is never going to be helpful for you as a business. So when you are doing any of these calculations, you should consider the cost of the product over its entire life cycle because that will lead to better and more refined decision making. This approach to costing is known as life cycle costing. This is the next discussion. Because a product's costs are not evenly spread through its life cycle costing tracks and accumulates costs and revenues attributable to each product over its entire product life cycle, and that will help you to better determine the profitability. So, how is the life cycle cost calculated? Basically, what you do is you take the total cost incurred over the entire lifetime of the product. Okay. What you do is you take the total cost incurred over the entire lifetime of the product, you divide that by the total number of units of that particular product, and that is your life cycle cost per unit. So the questions based on these are very, very simple. Let's see how these questions work. Chalo. Prepare a revised cost per unit schedule looking at the whole life cycle and comment on the implications of this cost with regards to the pricing of the product during the launch phase. Now, the following details relate to a new product that has finished development and is about to be launched. These are all, so this is cost in millions. This is cost in millions, R&D cost, marketing cost. This is production cost per unit, and then you have the production volume. This is also in million units. The launch price is proving a contentious issue between managers. The marketing manager is keen to start with a low price of around 8 to gain new buyers and achieve target market share. The accountant is concerned that this does not cover costs during the launch phase and has produced the following schedule to support this. Launch phase, the amortized R&D cost. This is your total research and development. The product life is 4 years, so amortized R&D cost is 20 million upon 4, that is 5 million. Marketing cost 5 million in year 1. Production cost 1 million units into 1 per unit. So 1 million. Total is 1. So total is 11 million. Total production units 1 million, you get cost per unit as 11. He's saying that if you keep 8 rupees as the selling price, then 11 rupees is the cost, and this is wrong. What they want you to do is they want you to prepare a revised cost schedule, and then they want to evaluate whether that 8 rupees price makes any sense at all to begin with. First of all, let us understand what is the situation here. The marketing manager wants to sell at $8 per unit, and the accountant has calculated cost per unit as 11. So he does not agree to fix the selling price at 8. He thinks that this will lead to a loss of $3 per unit. Now, what you should do is you should accumulate the overall costs incurred over life cycle. Okay? Accumulation of costs over the entire life cycle. ठीक है. In the launch phase, you incurred 20 million research and development cost. Research and development cost. Okay, 20 million. See, in the balance, see, this is costing. This is not financial reporting. In your balance sheet, you will capitalize this, you will amortize this, you will do everything correctly in the balance sheet, but that is as per the principles of financial reporting. This is not financial reporting. This is costing. Hence, you are including the full 20. Balance sheet, you will have everything properly. Then marketing cost. What is the marketing cost? Total 12.9. Okay, this is marketing cost of all the 4 years accumulated. Year 1, year 2, year 3, year 4, that is the total marketing cost of all the 4 years. Then, what is the next one? You have to calculate the production cost over lifetime. 1 million units into 1, 5 million units into 0.9, 10 million units into 0.8, 4 million units into 0.5. So, production cost overall 4 years. Okay, so you have 1 million units into 1 per unit, plus you have 5 million units into 0.9 per unit. Then 10 million into 0.8. 10 million into 0.8 and 4 million into 0.5. 1 into 1 plus 5 into 0.9 plus 10 into 0.8 plus 4 into 0.5. That is 15.5. What is there any other cost? No. R&D, marketing and production. These were the only cost. Okay. So take the total. This is total cost incurred over lifetime. 48.4 is the total cost incurred over lifetime. Then total number of units produced over lifetime. कितना प्रोड्यूस किया? 1 plus 5 plus 10 plus 4, 20. Write that down. 20. This is 1 plus 5 plus 10. Total cost incurred over lifetime and total number of units produced over lifetime. So, what is my life cycle cost per unit? It's going to be 48.4 upon 20, 2.42. 48.4 upon 20. This is my life cycle cost per unit. Okay. And let's write down the comments for you, and then we'll discuss the implications of this as well. Okay. I want you to read the comments first, and then we'll discuss the implications together. Okay. Chalo. Please start reading. Okay. So the original working of was 11 per unit, and they had, because they had done it for the first year. Now 2.42 is over the entire life cycle of the product. So if the traditional approach is used, the accountant's concern is valid. But if we go ahead with the life cycle costing approach, then the life cycle cost per unit comes to 2.42. So selling at 8 makes sense, which wouldn't make sense if we were using the traditional approach. Now, for people, who have been operating in the old way of doing things, in the traditional way of doing things, they might find life cycle costing to be a slightly misguided principle. Now, if you ask me as well, I would have my own reservations before taking or before accepting this as my final price, or before, saying that, okay, life cycle costing makes sense, because I need to see profits. And I come from a time where, unfortunately, I need to see cash profits also. I cannot just have accounting profits. I need to see cash profits. So for someone like me, this might not be the most, you know, acceptable way of doing things, but this is a modern technique, so we are using it. Okay. Now, whenever we talk of any product, any new item that is getting launched or whatsoever, that new item, new product that we are launching has a life cycle. As in, you cannot expect that a product will continue in the market till the end of time. I mean, people at some point must have thought that floppy disks will continue in the market till the end of time. You don't have a floppy disk now. I mean, you don't even have CDs anymore, right? I mean, I haven't seen a CD in the last 2, 3, 4 years, maybe, because now it has been replaced by so many other far more advanced techniques. When CDs came, we were, because, Santosh and I maybe can relate with it. We came from a time where the whole idea that, okay, something so thin that goes inside a computer can show things on the screen was an alien concept. So initially, when the whole concept of CDs must have been launched, they spent a lot of time, in the setup phase, in the pre-production or the product development phase, where they are doing research and development. They are trying to see what works, what doesn't work. And at that time, you are not really getting any returns, because you are only spending, you are experimenting till you have arrived at the most saleable version of the product. So that product setup phase, development stage, always involves more cost, and it doesn't really generate any return. When the product is ready and you launch the product, that is the launch or the market development stage. In this stage, you have, see, this is, the product is getting launched. People are now getting to know about the product. Okay. People are now getting to know about the product. So at that time, you need to make more and more people aware. And how will you do that? What you will have to do is, you will have to spend a lot of money on promotion. You will have to spend a lot of money on marketing. So that will become a challenge. And there will be a heavy cost outflow there, because people are not aware. Then the growth stage will happen. There will be bumper growth, but you will still have to keep on spending money on promotions. Maybe not at the same level as you earlier used to, but still you will have to spend money on that stage also. The variable cost will decline, because, because of economies of scale, but the fixed costs again will, keep on, and the fixed costs will keep on getting recovered over greater volumes. Now the product is in the growth phase. More and more, a lot of people know about it, and sales are also happening. Then it reaches a maturity phase, which is probably the product is at its top. You don't need to spend too much on marketing. Everyone knows that you are out there. People come to you because they are aware, they have consumed your product in the past, so they are coming to you again and again. That is the maturity phase of a particular product. And the last stage is, now the product has become outdated. There are better variants, there are nicer variants that are available in the market. So this demand for the product has declined, and the number of units produced also might go down because the demand for the product is not there. iPhone is, one product which has a new variant every year. 15 gets replaced by a 16, 16 gets replaced by a 17. And how does, or what impact or what change does that bring in for the company? Before somebody else could come up with a different version or a higher version, they themselves top up their product. So they push the old iPhone out of the market and they bring in a new iPhone in the market. In this declining stage, because कि अभी iPhone 15 nobody is going to buy, so the marketing cost will be cut, and your focus will move towards spending on the new product, which is iPhone 16. I mean, companies will have to regularly do it because innovation is absolutely essential. Unless you innovate and bring in new products, you will be kicked out of the market by someone who brings in a newer, happier, shinier variant of the same item. Okay, now if you want to maximize returns from a product, what you have to do is you should design costs out of the product, minimize the time to market, minimize the break even point, maximize the length of the life cycle itself. If you want to increase your returns, what they are saying is, if you minimize the time to market means if you reduce there are two times that they are talking about. One, the overall time that you spend in marketing, that time you have to reduce, or the time it takes to take the product from the production floor, or from the time it is ready in the company to its ultimate consumers in the market. If you can minimize the time to market, then naturally the costs will also be reduced, because the longer the product is in the pre-marketing phase or brand create awareness creation phase, naturally the uh, that is going to get impacted in some way or the other. Minimize the break even point. Break even point is going to be, one of our discussions later, very soon, by the way. Break even point is the point at which the company recovers the entire cost associated with a product. So they are saying if you minimize the break in point, you can maximize the return because you are recovering the costs quicker. If you elongate the life cycle, if you elongate the growth phase, if you elongate the maturity phase by staying on top of things, naturally you can expect better returns for yourself. And design costs out of the product means you will have to decide, you will have to identify which are the costs that you are incurring, and how many of those costs are necessary, how many of those costs are crucial, and costs which are not relevant, those costs might have to be phased out by doing a value analysis that we saw in the previous discussion of target costing. So life cycle costing, as I told you, is a simple discipline, is a simple approach, doesn't require a lot of effort. What I'm going to do for you is, now I'm going to give you three questions for homework today. You have to attempt the three questions. There is one calculation. There is one question which has true or false, typical section A question. And then there is one more question, which is again about calculation of the life cycle cost. After you have to attempt these questions today, and you will get the answer to these questions from my end. Don't worry about it. Okay. So we have finished life cycle costing also now. And then there is one more left, that is environmental management accounting. We'll take it up soon.